He manages billions of dollars. He has beaten the market consistently for decades. He has access to every research tool, every data source, every analytical framework that professional investing has ever produced. And when asked what gives him his edge, he said something nobody in the room expected. He reads old books about dead people, not market reports, not earnings calls, not the latest research from Wall Street's finest analysts, biographies, histories, the recorded experiences of human beings who faced profound uncertainty, made consequential decisions, and lived with the results. Because the market is not a math problem, it is a human problem. And human problems have been the same throughout history. The fear is the same. The greed is the same. The overconfidence, the panic, the inability to sit still when sitting still is exactly what the situation demands. All the same. Across centuries, across cultures, across every market cycle that has ever occurred. And the investor who understands people, deeply, historically, with the genuine empathy that comes from studying thousands of human lives across thousands of years of history, has an edge that no Bloomberg terminal can replicate. Today we go completely inside one of the most unusual and genuinely illuminating books ever written about the world's greatest investors, so completely, so thoroughly, that by the time this ends, you will not need to read a single page yourself. Every insight, every principle, every story, right here. This is Richer, Wiser, Happier by William Green, and nothing about how you think about investing, decision-making, or the relationship between financial success and genuine flourishing will feel the same after this. William Green is a financial journalist who spent 25 years interviewing the world's greatest investors, not reading their letters or studying their portfolios, interviewing them, sitting with them, asking them not just what they do, but how they think, what they value, what they have learned about markets and about life. And what he found across those 2 decades of conversation was both surprising and profound. The greatest investors are not primarily distinguished by their analytical capability. They are distinguished by their character, by the specific combination of intellectual honesty, emotional discipline, long-term orientation, and genuine curiosity that allows them to do consistently what most intelligent people find impossible. To think clearly under pressure, to act rationally when everything around them is irrational, to hold convictions firmly enough to act on them and loosely enough to abandon them when the evidence changes. This book is not primarily about investing. It is about the inner qualities that produce excellent judgment in any domain. And the investors' green profiles are case studies in how those qualities are built, maintained, and applied under conditions of genuine consequence. This book is for you if you want to understand not just what the world's greatest investors do, but how they actually think. This book is for you if you believe that the inner qualities that produce excellent judgment, patience, intellectual honesty, rational temperament are as important as technical knowledge in any high-stakes domain. And this book is for you if you sense that the lessons the greatest investors have learned about markets are also lessons about life. If any of those land, stay with this. The first idea is the one that reframes what investing mastery actually requires. The greatest investors are not the smartest. They are the most rational. Green opens by challenging the assumption that intelligence is the primary driver of investment success. The history of financial markets is littered with examples of extraordinarily intelligent people who destroyed their capital through overconfidence, through excessive complexity, through the inability to sit still when action felt demanded. Long-term capital management, run by two Nobel Prize winners and some of the most sophisticated financial minds of their generation, collapsed catastrophically because intelligence without emotional discipline is not just insufficient. It is dangerous. The investors' green profiles share a different quality, not higher IQ, but higher rationality. The ability to evaluate evidence honestly without the distortions that ego, fear, and social pressure introduce. The ability to hold a position through periods of intense discomfort without either selling prematurely or doubling down irrationally. The ability to distinguish between what they know and what they merely believe, between genuine conviction and motivated reasoning. Green quotes Charlie Munger, arguably the most consistently rational thinker in the history of investing. Munger says that the secret to his success is not being smarter than other people. It is being consistently less stupid, the discipline of identifying and eliminating the cognitive errors that most intelligent people make, and making fewer of those errors more consistently. That negative capability, the ability to do less wrong, is worth more than any positive capability in the markets. The second idea is the one that most investors understand intellectually and almost none practice. Patience is not passive. It is the most active. Discipline. Green profiles several investors whose primary competitive advantage is simply their willingness to wait. To hold exceptional businesses through periods of underperformance, through market cycles that punish their portfolio temporarily, through the noise and pressure that drives most investors to act when acting is exactly the wrong response. He tells the story of Nick Sleep and Qais Zakaria, two British fund managers who ran a concentrated portfolio of exceptional businesses and simply held them for years, through every market cycle, every period of underperformance, every moment when the pressure to change something felt overwhelming. Their primary analytical work was not finding new ideas. It was convincing themselves not to sell the ideas they already had, because they understood that the value of exceptional businesses compounds quietly, and that compounding requires time that most investors are not willing to give. Green also profiles Mohnish Pabrai, who built his investment approach on a single discipline: clone the best. Find the investors with the best long-term records, understand what they own and why, and copy them when the opportunity presents. Not because creativity is wrong, but because the best ideas in investing have already been found by people who have spent decades looking for them. And the investor who is honest enough to recognize that someone else has done the analytical work better than they could, and humble enough to act on that recognition, has an edge that most investors' egos will never allow. The third idea is the one that most surprised Green across his decades of interviews. The greatest investors are obsessed with not losing. Green noticed a pattern that runs through almost every conversation he had with the investors who have performed best over the longest periods. They do not talk primarily about finding the next great opportunity. They talk about avoiding the mistakes that destroy capital. Not what could go right, but what could go wrong. This obsession with downside is not timidity. It is the mathematical reality of compounding. Losing 50% requires 100% gain to recover. Losing 30% requires a 43% gain to break even. The asymmetry between losses and gains means that avoiding large losses contributes more to long-term wealth than finding large gains. And the investors who understand this asymmetry at a visceral rather than merely intellectual level build their entire process around its implications. Green profiles Howard Marks, founder of Oak Tree Capital and author of some of the most widely read investment memos ever written. Marx argues that the primary job of the investor is not to maximize return. It is to achieve the desired return for the minimum possible risk, not the lowest risk available, the minimum risk required. Because risk taken unnecessarily, return pursued beyond what the situation justifies, is not boldness. It is the beginning of the process that ends in catastrophic loss. The question every investor should ask about every position is not only how much can I make, but how much can I lose? And is that potential loss one I could absorb and recover from? The fourth idea is the one that extends beyond investing into every domain of judgment. Build a latticework of mental models. Green dedicates significant attention to Charlie Munger's intellectual framework, the concept of the latticework of mental models. The idea that genuine wisdom requires not depth in a single discipline, but breadth across many. That the person who understands only one way of thinking about the world is limited to the insights that one framework can produce, while the person who has internalized the core principles of multiple disciplines, psychology, biology, physics, history, economics, can bring multiple lenses to any problem and see what the single discipline thinker misses. Munger famously spent decades reading across every domain he could access, not to become an expert in each, but to extract the fundamental principles that apply broadly. The concept of compound interest from finance, the concept of natural selection from biology, the concept of inversion, solving problems backwards, from mathematics, the concept of incentives from economics, each principle extracted from its home discipline and applied as a general tool. Green argues that this intellectual breadth is not just an investing advantage. It is the foundation of the kind of judgment that produces genuinely good decisions in any domain of consequence. The investor who understands psychology makes fewer behavioral errors. The investor who understands history makes fewer predictions about unprecedented events. The investor who understands biology appreciates the power of slow compounding processes. The latticework is not a collection of facts. It is a collection of lenses. What is one discipline outside your primary domain that you have never studied seriously, whose fundamental principles might change how you think about the problems you currently face? The fifth idea is the one that most clearly connects the investing insights to the broader human question. The greatest investors have figured out something about happiness that most wealthy people never do. Green closes his interviews consistently surprised by a pattern he did not expect to find. The investors who have performed best, who have built the most wealth, who have sustained their performance across the longest time periods, are almost uniformly not primarily motivated by money. They are motivated by the game itself, by the intellectual challenge, by the genuine pleasure of thinking carefully about complex problems, by the satisfaction of being right, eventually, about things that most people got wrong. He profiles Sir John Templeton, who built one of the greatest investment records of the 20th century, while living with extraordinary frugality, genuine generosity, and a spiritual commitment to finding the maximum good he could do with the resources his investing produced. Templeton did not invest to accumulate. He invested because investing was the most effective tool available for generating the resources to do the things he genuinely cared about. And Green argues that this orientation toward the game rather than the score, toward the contribution rather than the accumulation, is not just philosophically admirable, it is practically superior. because the investor motivated by the intellectual challenge maintains their discipline through the periods of underperformance that destroy the motivation of the investor who is purely score-focused. Because the investor oriented toward genuine contribution makes decisions with a time horizon that the purely wealth-motivated investor cannot sustain. The question this forces is deeply personal. What are you actually investing for? Not what you tell yourself, what genuinely motivates the decisions you make. The sixth idea is the one that makes everything applicable. Invest in yourself. First, always. Green finds one more consistent pattern across his interviews with the world's greatest investors. Almost all of them credit a specific commitment to their own continuous education as the foundation of everything else. Not just reading about markets, reading about everything. Not just staying current, going deep. Building the kind of genuine intellectual capital that compounds across a lifetime in ways that financial capital alone cannot. Munger has said that he has not met a genuinely wise person who does not read constantly. Buffett estimates he spends 80% of his working day reading. Not because reading is intrinsically virtuous, because the person whose knowledge compounds across decades has an advantage that no amount of capital or connection can replicate. Because the genuinely curious person who reads widely across disciplines and thinks carefully about what they read builds a kind of wisdom that no formal education produces. Green argues that this commitment to continuous learning is not the privilege of people who already have time. It is the investment that creates the judgment that creates the time. And the person who treats their own education as the highest priority investment available will compound not just their financial capital, but their human capital across a lifetime. What would it mean to treat your own continuous education with the same seriousness that the greatest investors treat their portfolios? Invest in yourself relentlessly, always. Now, the honest warning. Reading about the greatest investors will not make you a great investor. Understanding Munger's lattice work will not build it for you. Watching this video will not develop the emotional discipline that holds conviction through periods of intense pressure. Only practice will. Only the daily, consistent, sometimes humbling work of reading widely, thinking carefully, building the emotional discipline that rational behavior under pressure requires, and investing in your own judgment as seriously as you invest in anything else. Think better. Live better. Always. Here are your 4 action steps this week. Step 1. Identify your primary investment motivation. Not what you tell yourself, what actually drives your investment decisions. Is it the intellectual challenge, the accumulation, the security, the freedom? Be honest, because motivation determines behavior, especially under pressure. Step 2. Apply the downside test to your most significant current position. How much can you lose? Is that potential loss one you could absorb and recover from? Does the answer change anything about the position? Step 3. Identify one discipline outside your primary domain that you have never studied seriously. Choose one book from that discipline and commit to reading it in the next 30 days. One book, one new lens. Step 4. Calculate what percentage of your current learning investment goes toward your own education, not just financial education, everything. And ask whether that percentage reflects the priority that the greatest investors would assign it. Let us bring this home. Richer, Wiser, Happier by William Green is not a book about investing. It is a book about excellence. about the specific inner qualities that produce consistently good judgment under conditions of genuine consequence, and the lives that those qualities make possible. It teaches you that the greatest investors are not distinguished by their analytical tools. They are distinguished by their character. By patience, intellectual honesty, the obsession with not losing, and the genuine curiosity that treats every domain of human knowledge as a potential lens, and that these qualities, however they were developed, are available to anyone who decides to build them. So let me leave you with one question. If you applied the same patience, the same intellectual honesty, the same obsession with avoiding mistakes that the greatest investors apply to their portfolios, to the most important decisions in your own life, what would change? Drop a comment below and tell me which idea hit you hardest. Was it the rationality over intelligence distinction, the obsession with not losing, or the connection between continuous learning and compounding judgment? I read every single one, and if you are not subscribed, do that now, because next week we go even deeper. I will see you there.